episode of Save It, Spend It, Share It, a podcast about finances and how can we be a good steward with the resources we have been given. And today I welcome one more time our guest, Steve Clement. Thank you so much for being in our podcast. You are coming again in the area of taxes. Steve Clement is a CPA with many years of experience in the tax field and other fields as well. And we are very blessed to have you today to explore a little bit more about taxes.
Thank you.
I learned so many things in our first episode. It was, like I mentioned, we all pay taxes.
Yes, we do.
So even though this podcast will not make us an expert, it'll kind of, motivate us to start thinking about taxes, doing a little bit more research of, what is applicable to me. How can I be accurate in my filing? How can I prepare for my filing? And, what sometimes I think it's complicated with taxes is that there's so many different status when filing. So let's talk about different groups.
Okay.
Let's talk about groups and see how we can help each one of the groups. So let's start with single. How should a single person prepare for tax season? What are some things to consider?
So for a single individual, first of all, you start at the beginning of the year. Make sure you claim single on the W-4 form. During the year, if you need to take a look at it, bring out the last year's tax return and use that to compare with what you're earning today. At the end of the year, if you have a W-2 and a little bit of interest income, I strongly encourage you to use the IRS free file system. It's inexpensive, like no cost.
Oh, wow.
They'll do the IRS federal return, and California participates in it. Many other states participated in it as well. It's fairly self-explanatory and a whole lot cheaper than coming to someone like me. Save that money.
Why is a single filing easier than other groups?
I wouldn't say it's easier, other than the fact you're only dealing with yourself.
Okay.
You still get to fill out the same form. Maybe you're dealing with one W-2 rather than two or three. Although I do have clients who have a lot of W-2s for one individual. Some industries are that way. But for most of us, it's one W-2. So I say it's straightforward. You'll probably say, really?
So where do you file? Do you go directly to the IRS website?
Yes, irs.gov, or just Google Internal Revenue Service or IRS. Make sure it does have the GOV after it.
Yes.
Because there's plenty of people who would love to make you think you're dealing with the IRS. But I go to that website all the time for different reasons.
So another group. So single, they can go into the website and they could file their own returns. If you were not listening on our previous podcast, I would recommend that you go back on our previous podcast, because we talked a little bit about strategies and advantages on filing. So now, what is the next group that we have?
So you have a married couple with no children. Again, if you just each have a W-2, or if just one of you works, then IRS website probably will take care of it. You can also use a preparation service. The big one out there is, of course, H&R Block. But there's a lot of individual tax preparers out there that are good. I'm biased toward using a CPA, but we tend to be more expensive than other repairs.
Well, knowledge comes at a price, right?
And it is knowledge. So, a married couple with no kids, if you don't own a home and don't give more than $30,000 a year in charitable donations, the standard deduction works for you, which is in the range of about $30,000. I should probably go back on the single individual.
Mm-hmm.
Half of that, $14,000 to $15,000, is where it is for a single individual with the standard deduction.
So who can claim a standard deduction?
Everyone.
Everyone.
So the first $15,000 or $30,000, depending on single or married, is totally tax-free. And if your income doesn't exceed that, you don't even have to file a tax return.
Mm-hmm.
And if you're on Social Security, which some people are, there's a formula that you use, but essentially you take half of your Social Security and any other income you have. If that doesn't exceed $15,000 for a single individual, $30,000 for a married couple, you do not have to file a tax return.
Oh, wow. So nothing. No
Nothing.
filing.
So that's taking half of your Social Security plus everything else. And I have clients who get to the point where their income is below that threshold. I say, you don't need me anymore. I love to talk with you, but I don't need to charge you. And they smile and say, thank you. I've learned long ago, I don't need more clients. I'm very busy. And if I can save someone dollars, why not? Why pay somebody to do a tax return that doesn't have to be filed? But again, it has to be below that threshold.
Below the threshold. So anyone can qualify for the standard deduction.
Everyone qualifies.
And that would still be a tax return that can be filed through the IRS.
Yes.
As long as they only claim the standard deduction.
Correct.
So what could bring another layer of complexity when it comes to a married couple?
So children. So having children.
Yes, kids are always complicated. So yeah, that's very true.
you now get to claim a credit.
Okay.
If your income's under a certain threshold, and for most of us, we qualify. And that's a $2,000 credit per child.
Oh, wow.
If they're under the age of 17. At 17 and above, it drops down to $500. And that continues while the child is in college up until they turn 24. So, and it can even continue beyond that if the child does not have any other sources of income or minimal sources.
Okay, so ideally by 24 they would be working, right?
Let's get them working.
Let's get them working and producing some income.
But there's a reverse side of it. What if you're taking care of your parents?
Mm-hmm.
You can claim that $500 exemption for the parents as long as you're providing over half of their support. And there are ways to tweak that number to make it work in your favor. But yes, you can claim a parent as well.
So claiming our kids in their return, you previously had mentioned that they did not have to file if their income was not higher than $14,000?
$14,000 to $15,000.
So you can claim them as long as they stay below that threshold.
Actually, you can claim them even if they earn more than that.
Oh, okay.
So, good question to be asking. As long as you're providing more than half of their support.
Okay.
That's the basic rule. And for a child, if they're a student going to college on at least a part-time basis, you can claim them as a dependent.
So even though they're working and earning above that threshold, I could still claim them.
And by the way, none of their income gets reported on your return.
Okay.
It's all on their own individual return, only if they earn more than that standard deduction, the 14 to 15,000 range.
Okay. So no return under that amount, and they would be on a separate return anyways.
Correct.
Okay. That's
So I'm going to make a little adjustment to that.
Mm-hmm.
That's 14 to 15,000 as if it's W-2 income.
Mm-hmm.
If it's investment income, it drops way down to about $1,500.
Okay.
So 99% of us, our
Are
kids
gonna-
have to earn money.
Yeah. Yeah.
They don't get investment income. They may have a little savings account, but
Mm-hmm.
so kids do add a little complication. Then you have the next level, which is being able to itemize.
Mm.
And if you're itemizing, I recommend for most people who ask me, go get TurboTax. If you have a business, if you have rental properties, if you're doing something unique, that's when you need a professional like myself. So for many people, yes, you own a home, and if you're buying in California today, you are paying
Interest.
a lot of interest expense.
Yeah.
Plus you get to deduct property taxes, and yes, your state income taxes fit in there as well as a deduction. Even the DMV fees you pay on your car is a deduction. Add to that any charitable contributions, and most people who own a home can justify itemizing and claiming charitable deductions. I encourage them to give to their favorite charities.
Mm-hmm.
As I mentioned in the last podcast, mine happens to be church, which if you are involved in a church, lavish them. You're not there just to be entertained. You're there to help support.
Yeah, to support a mission and purpose.
Absolutely.
So basically we would need to analyze the standard deduction versus everything that I contribute that falls on the list of items that I could itemize.
Correct.
And then evaluate, which group it's larger, which has more contributions.
So if itemizing is higher than the standard deduction, hands down you itemize. It's much, much better.
And once you enter into itemize, make sure that you have the supporting documents.
Absolutely. If you remember, I said for charitable donations specifically, anything that's $250 or more, you must have a letter or a receipt
Mm-hmm.
that says no goods or services received. You always have to have a canceled check or a credit card charge to support the fact that you did give the money.
The money to the charitable.
And interestingly, the IRS wants to see everything if they do an audit.
Mm.
They want to see the receipt, then they want to see the canceled check or the credit card.
Wow. So keep the records.
Keep the records, absolutely. And by the way, my recommendation for keeping records, since
I was just going to ask you that. I'm glad you're bringing this up.
5 years.
5 years.
5 years.
Okay.
Because the IRS has a 3-year statute of limitations, and here I go using a tax term.
Mm-hmm.
Basically, it says the IRS cannot audit if you go beyond 3 years, with a few exceptions, very few. California and most states have a 4-year statute of limitations. And I throw in a 5th year because it's much easier to think about.
Mm-hmm, mm-hmm.
So save records for 5 years. Anything that touches your tax return, like those credit card receipts, those bank statements, the actual donation letters, your mortgage interest statements, your property tax bill. And if medical, that's a whole different realm of keeping receipts because you're talking about a lot of pieces.
Mm-hmm.
But medical is a pretty high threshold. It's 7.5% of your income. So if someone earns $50,000, you've got to spend out of pocket well over $3,000.
Mm-hmm.
And if you have good insurance, you're not going to spend that.
Yeah. Yeah, so that's very important, because sometimes, we're just keeping paperwork that's not needed anymore, and we just have like 10, 20 years worth of filing.
Yes, we do.
And you go to your garage or your boxes and you're like, well, I don't know if I should keep them or not.
There's 2 or 3 exceptions to being able to get rid of documents at that 5-year mark. 1, I recommend always keeping your tax return itself forever. 2, if you own property, you need to save those records for at least 5 years after you sell it, which basically says don't get rid of anything with property.
Okay.
And those are the two main items. If you're putting money away out of your paycheck for retirement, or putting money into an IRA, keep a year-end record that shows that you've been making those contributions. Because does the IRS have the ability to challenge you? Anytime. The likelihood, very small. Mm-hmm. I have over 1,000 clients. And if I see the IRS 2 or 3 times a year, lately that's been a lot. At one time it was much higher. So, is there a chance that the IRS could ask? Always. Mm-hmm. And I live with the attitude of, I like to sleep at night. I want my clients to sleep at night.
Absolutely.
Keep records.
Yeah.
Let's not play games.
Yes, absolutely.
There's a lot of leeway in there, because, in my opinion, there's this much black, this much white, and a lot of gray in between.
Yeah.
As my job as a professional to make the judgment call as to what we can justify. So if we can justify it, keep those documents.
Wow. And I don't want to detour the subject too much, but you mentioned keep your filing. What if, you're looking for a filing, you're like, I don't remember, I don't have a copy, the bank or whatever transaction requires the filing. How can you look it up in the IRS or somewhere?
You can request a transcript from the IRS going back 3 years easily. I go back a fair amount longer than that, but after about 8-9 years, they don't keep records.
Okay, well, that's great to know. So now going back to the different groups that we were analyzing when it comes to tax filing, we said married filing jointly. Is there any moment where it's most advantageous married filing separately?
Rarely. It usually has to do with itemizing, where one person has a huge medical bill and it helps you a little bit there. Or, unfortunately, the main reason I see it being used is when a divorce is imminent, when a couple are separating. And that hurts when I see that. So, married filing separate, the tax rate is supposed to be half of the married filing joint. Mm-hmm. It usually tends to be a little bit more expensive.
I see.
Unless one spouse has a lot higher income than the other, then for the spouse with a higher income, it's extremely expensive. So, married filing joint, by all means, always the best.
The best option. Okay. Is there another group of filing?
Yes, there is. There's always one more.
Okay.
Or so. It's head of household.
Okay. Who's the head of household?
And that's where you have a single individual who's responsible for a child or a parent. So, divorced couples, you have one parent who can claim a child. So if there's 2 children, each one tends to take one. If there's one child, I've seen it bounce back and forth every other year, where one claims and one doesn't. Head of household means you get a little better tax rate than a single individual. And it does help. That means you're providing more than half the support, or between you and your ex, you've got an agreement, and the IRS does want documentation that says you have the right to claim this child this year. And it can say every even year, every odd year.
Mm-hmm.
So, or you're a single parent or a single individual taking care of a parent.
Mm.
You have the right to claim head of household again. Again, you're providing over half the support.
Oh, well, so it could go back and forth. A child or dependent being 1 year with one parent and the other one.
Yes.
Or in case that you have 2 or 3, just split, 2 and 1. Or,
that is correct.
Oh, interesting. So those are the groups that the filing, how it could
one
be.
More.
Oh, one more. Okay, one more.
That's a widow.
Okay.
For 2 years after a spouse has passed away and you have children, you still get to claim married. So it's a special category. Fortunately, I don't see it too often. But just be aware there is.
That there's that other category for widow. Unfortunately, in a perfect world, we would all be filing on time. We would all be paying and preparing for taxes and not scrambling April of, where are my documents? How much am I going to pay? Oh, you have to pay this amount. And you're not ready. So this year I have to pay $10,000 additionally in taxes, but I don't have the money. So now I'm getting a letter from the IRS saying, hey, guess what? You owe us $10,000 and you have to pay us. And then you get hit with a second letter saying, guess what? You did not pay last year. And all of a sudden, you have this $50,000 debt that how can you even move forward? What could you recommend someone struggling with taxes on taking that first step?
I cry internally.
We can cry together.
when
yes.
someone comes to me with that situation.
Yeah.
There are not good answers. You have to pay the tax. My recommendation is you work out an installment plan with the IRS. The IRS is very flexible if you owe less than $50,000. And for most of us, we're talking $3,000, $5,000 in a year. Yes, if you let it build up over several years, it can really grow. And the IRS isn't kind. They're a tax collector. They're not here to make us comfortable.
Yeah.
So if you work out a payment plan, they won't bother you as long as you stay on that plan. And 3 years, if you can pay it off in 3 years, no questions asked what you think you can pay. Tell us what you can pay and we'll work with that. If it's longer than 3 years, you have to provide documentation. Or if it's over $50,000, you have to provide documentation to show what your capabilities are, and they will require you to make a specific payment. Ideally, they want you to give them a bank account and they'll automatically deduct it. Is there a way to get around that? Not easily. I have people coming to me and saying, oh, but I hear the ads on the radio and TV saying, come to us, we'll get you out of taxes.
Yes.
Pure and simple. If the IRS thinks you have the cash flow, they're not going to let you out. The examples that are used are people who could not afford to pay in any way, shape, or form. But the ads never say that. And it's a long process to go through. So essentially, you have to prove you're destitute. But again, it hurts when someone owes that kind of money. And I've had people come to me and first thing I tell them to do, make sure you are current on this year's tax, because the IRS will take that into consideration in working out a payment plan that either you offer or they require. So if you're withholding enough for the current year, that's key. If you have to set money aside, do it. And when you use the term setting aside, I'm talking about a self-employed individual who has to make estimated taxes. Mm-hmm. You've got to pay that money in. You can't just put it in a bank account. So you've got to stay current. In fact, the IRS will kick you out of an installment payment plan if you aren't current for the next year. Oh. Now, will they put you back into one? I've seen situations where they will, but their approach...
you don't want to find out if that's going to happen or not.
The IRS's approach is you only qualify for an installment payment plan if you're current for the current year.
Could they seize your assets?
Oh, yes, very much so. The first asset they'll go for is your bank account. It's called levying your bank account. The next asset they'll go for is garnishing a paycheck. And then they'll put a lien on assets that you own, a home or property. You don't want to go there. So,
absolutely.
It's painful. And yes, you've got to cut back because the IRS has first rights on your money. They even have the right to take Social Security.
Wow.
So, or retirement. Mm-hmm. So there's limits.
So then, we need to face that we are in a problem. Ignoring it, it's not going to help.
It will not go away.
It's just we need to enter a payment plan and readjust our budget.
Correct.
And unfortunately, maybe that's going to translate into not having vacation time.
I've had to advise a number of clients, all you have the ability to do is pay your rent, utilities, food, gas. Everything else has to be used to pay the IRS back.
And one verse that I think would be helpful for us in this situation would be one that we find in Luke 14. It's an analogy that is referring to discipleship, but it also brings the analogy of, suppose that you want to build a tower. The first thing that you have to do is you need to count down the cost.
Yes.
If you want to get out of debt, you first need to make sure what you just mentioned. Just pay your basics. Just pay your rent, your utility, your food, your gas, and you have no extra space.
Yeah. You may not be able to go out to the restaurant.
Yeah.
It's a whole lot cheaper to buy groceries, even though you may not like to cook.
Yes. Yes. And, facing reality, it's a hard thing.
It is.
It's a hard thing, but we need to own our mistakes or own our life situation. Sometimes life hits us with a lot of things.
It can.
And it's a reality, and we need to be able to adjust.
Very much so. I've dealt with many a client who, when they finished making that last payment, said, "Oh, what a relief."
Yes.
It takes a huge weight off of your shoulders.
Yeah, absolutely. So, this podcast was very helpful, and I hope that it also brings us hope that even though we have not been managing our taxes well, we can always rectify.
Yes.
We can always readjust. Yes, it's going to take a time to readjust and get back to track. But, those of you that are listening to this podcast, reach out to a tax professional.
Yes.
If you are in a situation that you really need help and you're struggling, yes, you're gonna have to pay some service fees, but in the long run, it'll get you started to be in a better place, to find out a strategy, to find out a way of making payments on time and stay on track.
That is so true.
So thank you very much for being
You're
more
welcome.
time in our podcast. Thank you for coming back, and we hope to see you again. We'll expand at a later time this tax, because I think taxes, it's something that there's so much to learn.
Unfortunately, it affects all of us.
Yes, that's true. So thank you for listening. Thank you for being part of this podcast today, and we hope to see you soon.